something just changed in XRP that matters more than it looks. Not because XRP itself has changed overnight, but because the Federal Reserve may be shifting back towards tighter monetary policy. And history shows that those moments have often reshaped the entire crypto market. Short-term volatility is one thing, but liquidity cycles have repeatedly determined where capital flows next. In this video, we'll break down the latest Federal Reserve signals, what futures markets are pricing in, why an 85% probability of another rate hike deserves attention, and what history suggests that could mean for XRP, XLM, HBAR, and ICP, and the broader crypto market. See, the catalyst was a simple statement from Federal Reserve Chair Kevin Walsh. He said prices are still too high. 4 words, but potentially a major shift in the market narrative. For months, investors have focused on when interest rates might actually and eventually come down. Now that conversation is increasingly shifting towards whether the Federal Reserve may need to tighten policy again if inflation remains stubborn. That distinction remains and matters because every major crypto cycle has unfolded within a broader liquidity cycle. See, when liquidity expands, risk assets often benefit. When liquidity contracts, markets typically become much more selective. But here's the question that matters the most. If markets are already expecting another rate hike, has the risk already been priced into XRP, or is there another piece of the story that most investors are overlooking? Let's start with what actually changed. Ladies and gentlemen, if you want the satellite perspective on XRP, HBAR, ICP, XLM, and crypto, and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Recently, Federal Reserve Chair Kevin Walsh delivered comments that immediately caught the attention of economists, institutional investors, and futures markets. His message was straightforward. Prices remain too high. That may sound like a simple observation, but for central bankers, every word carries enormous weight. The Federal Reserve operates under what is known as its dual mandate. Its first responsibility is maintaining price stability. Its second is maximizing sustainable employment. Those two objectives usually work together, but sometimes they come into direct conflict. When inflation accelerates too quickly, the Federal Reserve has one primary tool available: interest rates. High interest rates makes borrowing more expensive. Consumers spend less. Businesses invest more cautiously. Credit growth slows. Demand begins cooling. And eventually inflation follows. It's an intentionally restrictive process designed to remove excess liquidity from the financial system. That is why investors pay such close attention to every speech given by Federal Reserve official. Markets aren't just listening to what they say. They're trying to understand what policy decisions those words might lead to. Because policy drives liquidity. Liquidity drives asset prices. And asset prices often determine investor sentiment. That is why macroeconomics matters so much to crypto, even if it doesn't always seem obvious on the surface. But here's where it gets interesting, ladies and gentlemen. Despite these increasingly hawkish comments, the Federal Reserve has not actually raised interest rates. Not yet. And in fact, according to futures markets and CME FedWatch data, investors overwhelmingly expect the July meeting to end with no change in interest rates. And that's an important distinction. Markets are not reacting to an actual rate hike today. They're reacting to the probability of one happening later. And probabilities often matter just as much as the final decision. Because financial markets are constantly pricing tomorrow's expectations, not yesterday's news. That brings us to one of the most important numbers investors are watching. Current market pricing suggests that there's roughly an 85% probability that the Federal Reserve delivers at least one interest rate hike before the end of 2026. Let that sink in, write that down. 85%. That's not certainty, but it's high enough that professional investors simply cannot ignore it. Ladies and gentlemen, if you want to understand where our research suggests interest rates and liquidity and broader macro cycles are headed, come and join our Patreon community of over 600 active investors and traders who are positioning themselves for what's coming, not reacting after the fact. We share our market research, market updates, portfolio positioning, and the key trends we're watching as they develop. You'll find the link in the description below. Think about how prediction markets have evolved over the past decade. Whether forecasting elections, commodity prices, or managing monetary policy, markets often aggregate thousands of independent opinions into one collective probability. No individual investor possesses perfect information, but collectively, markets frequently identify trends long before they become obvious. which is exactly why institutional investors monitor future markets so closely. They're not looking for certainty. They're looking for probability. Now, this is what most people miss. There is a huge difference between expecting one rate hike and expecting an aggressive tightening cycle. Write that down. That's massive. And those are two completely different macroeconomic environments and narratives. When we look inside the Federal Reserve itself, the picture becomes even more nuanced. Among the 18 policymakers currently participating in the Federal Reserve's economic projections, opinions remain remarkably divided. Approximately half expect at least one additional rate hike before the end of next year. The other half believes rates may remain unchanged or eventually move lower. In other words, there isn't unanimous agreement. The Federal Reserve itself is effectively split down the middle. And that's actually significant because markets usually become far more volatile when policymakers themselves are uncertain about the future path of monetary policy. This isn't the environment of 2022 when inflation was surging and the Federal Reserve was delivering multiple consecutive rate hikes. Today's environment is far more balanced. Inflation remains elevated, enough to keep policymakers cautious, but economic growth has also slowed enough to prevent an aggressive tightening campaign. That balance creates uncertainty, and uncertainty often creates opportunity. Throughout financial history, markets have rarely waited for official decisions before moving. Instead, they anticipate, they reposition, they price in expectations months ahead of reality. One of the clearest examples came during the 1994 Federal Reserve tightening cycle. Long before every policy decision had been implemented, bond markets had already begun adjusting to expectations of higher interest rates. Investors who waited for complete certainty found themselves reacting after much of the repricing had already occurred. The lesson wasn't simply about interest rates. It was about expectations. Markets don't reward investors for knowing what happened yesterday. They reward those who correctly anticipate what happened tomorrow or could happen tomorrow. See, today's crypto markets find themselves facing a remarkably similar psychological challenge. Everyone is asking whether the Federal Reserve will eventually tighten policy again. But professional investors are asking a different question. How much of that possibility has already been priced in today's market? That distinction matters enormously because markets rarely move based solely on events. They move when reality differs from expectations. See, this is where XRP the Anointed One enters the conversation. For years, many investors have focused almost exclusively on legal developments, partnerships, or adoption headlines. Those factors absolutely matter, but they don't operate in isolation. Every major financial asset exists within a much larger global liquidity cycle. When central banks inject liquidity into the financial system, capital often becomes willing to move towards higher risk assets. When liquidity tightens, investors typically become more defensive. That's why understanding the Federal Reserve isn't just important for stock investors. It's increasingly important for crypto investors as well. Because whether you're looking at XRP, XLM, HBAR, ICP, or even Bitcoin itself, none of these assets exist outside the global macroeconomic environment. Prices are reacting, but the system's evolving. And once you begin separating those two ideas, the market starts making far more sense. But here's where the story becomes even more compelling. Because when we compare today's Federal Reserve outlook with what happened during the last major tightening cycle, an unexpected pattern begins to emerge. One that completely challenges the narrative most investors believe about interest rate hikes, about why some of the biggest opportunities of crypto have historically appeared when fear was at its absolute highest. If there's one lesson financial markets teach over and over again, it's this. The event everyone fears is rarely the event that causes the greatest damage. More often than not, the greatest damage is done by uncertainty leading up to the event. And once the event finally arrives, markets begin looking forward instead of backwards. That's exactly why it's worth revisiting the last major Federal Reserve tightening cycle, ladies and gentlemen. Because while many investors remember the fear of 2022, far few remember what happened immediately afterwards. Interest rates rose at the fastest pace in decades. Let that sink in. Liquidity was withdrawn from the financial system, risk assets sold off aggressively, technology stocks suffered, venture capital slowed, speculative investments became increasingly difficult to justify. And naturally, cryptocurrencies were among the hardest hit. Bitcoin declined dramatically from its highs. All coins experienced even deeper corrections. XRP was no exception. Investor sentiment reached levels that at that time felt almost impossible to recover from. Social media was dominated by fear. Every rally was described as a dead cat bounce. Every decline convinced more investors that lower prices were inevitable. Yet history often produces its greatest opportunities precisely when confidence disappears. Let that sink in. This is so important. That's why I tell you to pay attention to what's quiet always, so you don't get caught up like sushi. Because markets are forward-looking. They don't wait for perfect economic conditions. They begin recovering when investors believe tomorrow could be slightly better than today. That subtle shift changes everything. But here's where it gets spicy and interesting. When analysts compare Federal Reserve policy with crypto market cycles, they often focus only on the beginning of rate hikes. Far fewer pay attention to what happens near the end. By the time central banks have tightened monetary policy significantly, liquidity has already been restricted for months. Businesses have adjusted, consumers have adapted, financial markets have repriced risk. In other words, economic pain has already been absorbed, much of it. That's why market bottoms frequently occur before central banks begin easing policy. It's one of the biggest misconceptions in investing. Many people assume markets often rally after interest rates are cut. History suggests something different. Markets often begin recovering while monetary policy is still restricted because investors anticipate the next phase long before it officially arrives. Short-term noise, long-term structure. Those four words summarize countless market cycles. Prices react to today's headlines. Capital responds to tomorrow's expectations. One of the biggest historical examples comes from the United States in 1982 in the recession. At the time, the economy was under enormous pressure. Interest rates had been pushed to exceptionally high levels to finally defeat years of persistent inflation. Businesses struggled. Unemployment climbed. Confidence remained extremely low. Yet while economic headlines still appeared overwhelmingly negative, financial markets quietly began building a foundation for one of the strongest bull markets in modern history. The economy hadn't fully recovered. Optimism certainly hadn't returned. But investors slowly realized the most aggressive phase of tightening was approaching its conclusion. Markets moved before the economic data improved, not after. That's an important distinction because financial markets discount the future. They don't wait for newspapers to announce that conditions are safe again. By then, much of the opportunity had already passed. Could today's environment follow the exact same path? No. History never repeats itself perfectly, but it often rhymes. And that's exactly why institutional investors study previous monetary cycles so closely. They're searching for patterns, not guarantees. Now let's bring this back to XRP, the anointed one. When you overlay previous Federal Reserve tightening periods with XRP's historical price behavior, an increasingly interesting pattern starts to emerge. Periods of maximum pessimism often occur very close to important long-term turning points. That doesn't mean every correction immediately becomes a buying opportunity. Markets can always remain volatile long after investors expect. But it does remind us that price and sentiment rarely reach their lowest points after optimism has already returned. Instead, they bottom while fear still dominates the conversation. That's exactly what happened during previous crypto cycles. Most investors weren't celebrating. They were exhausted. Many had already sold. Others had simply stopped paying attention together. Ironically, those periods often create the strongest long-term opportunities for patient investors. Again, not because anyone could predict the exact bottom, but because valuations had already adjusted to extremely negative expectations. That's an important difference. Professional investors rarely try to buy the exact lowest price. They never try to catch a falling knife. They focus on accumulating when risk and reward begin shifting in their favor over time. Now, this is what most people miss, unfortunately. Everyone wants certainty, but markets almost never provide it. Instead, they reward participation and preparation. Imagine standing on a shoreline watching the tide. You never know the precise second the tide changes direction. For several minutes, the water appears almost motionless. Small waves continue moving towards the beach. Nothing looks different. Then gradually, almost the blink of an eye, the current begins flowing the opposite way in a flash. Financial markets behave remarkably similar. I always go over this and discuss this principle. I learned this on the New York Mercantile Exchange. It was drilled into my head. But by the time everyone has agreed the trend has changed, unfortunately, most of the move has already happened. That's why experienced investors spend more time studying liquidity than headlines. Because liquidity changes direction before narratives do, and narratives change before public sentiment catches up. That brings us to another useful historical comparison. Think about the construction of the great medieval cathedrals across Europe. Workers often spend decades laying foundations that remain almost completely invisible. For years, observers saw very little progress above ground. Some questioned whether anything meaningful was happening at all. Yet beneath the surface, the structure supporting everything else was slowly taking shape. Financial markets often behave in much the same way. Price action captures everyone's attention because it's visible. But beneath the surface, liquidity, institutional positioning, regulatory clarity, and capital allocation are quietly building the foundation for the next cycle. When that foundation is complete, price often moves much faster than most people expect. The visible breakout is simply the final stage of the work that has been developing underneath for months. Price is reacting, the system's evolving always. So where does that leave us today, ladies and gentlemen? The market currently expects the Federal Reserve to keep rates unchanged in the immediate future. At the same time, futures markets continue assigning high probability to at least one rate hike before the end of 2026. That combination creates an unusual environment. Short-term caution, long-term uncertainty, neither extreme optimism nor outright panic. And historically, those transition periods have often been where the biggest questions and the biggest opportunities begin to emerge. Because the conversation is gradually shifting away from whether inflation exists toward how restrictive monetary policy actually needs to become. That distinction may ultimately matter far more than a single quarter-point rate hike. But the story doesn't end with the Federal Reserve, ladies and gentlemen. Because while history and investors remain focused on interest rates, they always are, another set of forces is quietly reshaping the digital asset market. Institutional participation is expanding. Market infrastructure continues evolving. And when you combine those structural developments with the historical relationship between liquidity and crypto markets, a much bigger picture begins to emerge. One that could explain why today's fear looks very different from previous bear markets. If you followed financial markets for any length of time, you've probably noticed something curious. The biggest headlines rarely mark the beginning of a trend. More often, they arrive somewhere near the middle or even close to the end. By the time most investors become convinced that something is either incredibly bearish or incredibly bullish, institutional capital has usually been positioning itself for months. That's why understanding today's macro environment requires separating two very distinct and different ideas. The first is price. The second is structure. Price can change dramatically in a matter of days. Structure changes over years. And right now, those two stories may be telling very different things. Short-term noise, long-term structure. It's a distinction that could become increasingly important as we move through the remainder of this cycle. Let's assume for a moment that future markets are correct. Let's assume the Federal Reserve delivers one additional interest rate hike before the end of 2026. Would that automatically end the long-term outlook for digital assets? History would suggest the answer is far more complicated. Markets rarely move because of one isolated event. They move because investors continuously reassess expectations. If a single rate hike has already been widely anticipated, much of its impact may already be reflected in today's price. That's why professional investors spend so much time asking one question. What isn't the market expecting? Because surprises, not scheduled events, are what typically produce the largest moves. This is precisely why every Federal Reserve meeting matters, not simply because of the decision itself, but because of the language, the tone, the projections, and whether policymakers sound more confident or more concerned than markets expect. And whether policymakers sound more confident or more concerned than markets expected. Sometimes a single sentence can change billions of dollars of capital flows. But here's where it gets even more interesting. While investors remain focused on monetary policy, another transformation continues quietly in the background. The infrastructure supporting digital assets keep expanding. Institutional custody solutions have matured. Tokenization concerns are attracting attention across global finance. Continuing. This is really important, ladies and gentlemen. Payment infrastructure is becoming increasingly digital, which is really important as well. Settlement technology continues evolving. None of these developments guarantee higher prices tomorrow. They don't. It's like watching paint dry on the wall. But they represent structural changes that extend well beyond one interest rate decision. That's why it's important not to confuse market cycles with technological progress. The two often move at different speeds. Technology can continue advancing while prices struggle. Prices can rally long before widespread adoption becomes obvious. They're related, but they aren't identical. Price is reacting, the system's evolving, and understanding that difference allows investors to look beyond daily volatility. For holders of XRP, XLM, HBAR, and ICP, that distinction matters. Each project is frequently discussed within the broader conversation around cross-border digital payments, digital infrastructure, security, and enterprise blockchain adoption. Markets will continue debating valuations. They'll continue debating timelines. They will continue reacting to macroeconomic headlines. But the larger question remains whether the underlying ecosystem continues developing over time. That's the question institutional investors increasingly ask. Not what happened today, but rather what direction is the system moving over the next 5 to 10 years. Those are very different conversations, and they often produce very different investment decisions. Now, this is what most people also miss, unfortunately. Many investors spend enormous amounts of time and energy trying to predict the exact bottom, the exact week, the exact day, sometimes even the exact hour. History suggests that's an incredibly difficult task. It's like the definition of insanity with this. To me, the definition of insanity is doing the same thing over and over again, hoping for a different outcome. Nobody ever calls the top or catches the bottom. The trick here is to try to get up when it's going up and try to get out before it started to go down. That's the trick. But markets rarely ring a bell announcing that their correction is finally over. Instead, bottoms tend to form through a process. Confidence slowly stabilizes. Selling pressure begins fading. Volatility gradually decreases. And almost without warning, the narrative changes. That's exactly why experienced investors often focus less on perfection and more on preparation. They believe the long-term thesis remains intact. They build positions gradually rather than attempting to perfect time every movement. You will never perfectly time every movement, ladies and gentlemen. It's impossible. That approach doesn't eliminate risk. Nothing can, but it can recognize one of the investing's oldest lessons. Missing the beginning of a major trend can sometimes be more costly than buying slightly above the absolute bottom. So what should investors actually be watching over the coming months? First, Federal Reserve communication, not just the interest rate decision itself, but every update regarding inflation, employment, and future policy expectations. Second, liquidity conditions, because liquidity has historically played a major role in determining how much capital flows towards higher risk assets. Third, market expectations. Remember, markets don't react only to events. They react when reality differs from what investors had already anticipated. And finally, patience, because every major financial cycle has required it. Whether in equities, commodities, bonds, or cryptocurrencies, long-term investors have consistently been rewarded not only for reacting emotionally, but for remaining disciplined through uncertainty. None of this means volatility disappears, ladies and gentlemen. Far from it. If inflation proves more persistent than expected, markets could experience additional pressure. If economic growth weakens unexpectedly, policymakers may respond differently. If geopolitical events reshape global trade or energy, markets investor sentiment could shift quickly. There are always variables that no one can predict with certainty. That's why it's important to distinguish between probabilities and guarantees. Markets operate on probabilities, not certainties. Today's futures market suggests a high probability of another rate hike before the end of the year, but probabilities evolve. Economic data evolves. Central bank policy evolves, and markets evolve with them. That's exactly why remaining flexible matters. When we step back and look at the bigger picture, the story becomes surprisingly clear. Yes, the Federal Reserve appears increasingly concerned about inflation. Yes, monetary policy could remain restrictive longer than many investors had previously expected. And yes, that could continue creating short-term volatility across financial markets. But history also reminds us that some of the strongest recoveries have begun when uncertainty remained high, not after fear disappeared, while fear still dominated the headlines. That's why understanding history matters. Not because it tells us exactly what happened next, but because it reminds us how markets have behaved when faced with similar macroeconomic conditions. History doesn't repeat, but it often reminds. So here's the takeaway, ladies and gentlemen. Federal Reserve may not be preparing for another move. Markets are already adjusting to that possibility. Volatility could remain part of the journey, but beneath those daily price swings, larger structural changes continue unfolding across global finance and digital assets. Short-term noise, long-term structure, prices reacting, systems evolving. Those two ideas may end up defining this entire market cycle. If you found this analysis valuable, make sure you subscribe so you don't miss our next deep dive into the macro forces shaping crypto financial markets and the global economy. I'd love to hear your perspective in the comments below. Do you believe another Federal Reserve rate hike is already priced in the market, or do you think investors are underestimating its potential impact? Leave your thoughts in the comments below. Thank you for watching. Stay informed, stay disciplined. I'll see you in the next video. Hope everyone's having a blessed day, ladies and gentlemen. I want to welcome all the new members of the Patreon, Crypto Public Desk Monthly, all the new members of the membership channel. Ladies and gentlemen, Right now, we're seeing a classic change of the guard. None of this is financial advice in any capacity. It's my own opinion, what I'm going to say right now. This is my own opinion. What will happen in the next 24 months will be the defining financial changes in our lifetime. Either the West will control cryptocurrencies or the East will. Either the economic realities that we understand today will continue or they won't. Being a financial mercenary, you learn to survive daily financial combat. You learn to find alpha when it's plentiful and when it's the dry season. You learn the tricks where to find it. Nature is fascinating. It gives us examples. I always tell you, it's like the dry season in Serengeti. The water shrinks. Fishes turn cannibalistic. They eat each other to make sure that they get the oxygen in the water. Same thing with alpha. If you want to learn how to trade and you want to learn how to invest, come and join the Crypto Public Desk Monthly. It doesn't matter if you're a seasoned veteran or you just want to learn. Come and join over 600 active traders and investors who are enjoying the deeper macro research, who are enjoying to take advantage of everything that we just said. See, in the videos, they're free. We go over what we're looking at. But inside the Crypto Public Desk Monthly, we go over what we're trading, why we're trading them, and what we're looking for and why in equities, futures, everything, cryptos. Because one market doesn't dominate them all. One narrative doesn't dominate them all. What dominates them all is your trading account size, your peace of mind, your Gucci conviction, your Gucci clarity. Because if you don't got any of this, you're going to get cut up like sushi. Having Gucci conviction means to understand what's going to happen, why. See, if you want to know what we really think is going to happen with rates, do come and join the Crypto Public Desk Monthly and get on our Zoom calls each week that people are loving. Because you know what? There's no more trading floor. The trading floor is a computer. The most important thing about the computer is understanding how to use it. I think most people would agree. I don't like the computer. I learned how to chart with graphs. Most people have been in this game long enough. Have been. But understand something. When the Harry Houdini freak show about higher rates is over and banks are free to do what they were doing before, because all rallies and metals are being sold into right now because CTAs have to make money. Traders have to make money. You got to make your weekly, your quarterly, your monthly nut. You got to make your numbers. Everyone's lowering their price targets for metals this year. You got a lot of groupthink, like lemmings that go off the cliff. See, the BOJ's got enough capital to keep doing what they're doing. The narratives have changed. People thought gold was going to be replacing the US dollar. I'm not in that camp. I'm not. I don't think the unit in the BRICS will be successful. I'm not in that camp. I'll play both ends against the middle because I'm a financial mercenary without a doubt. Money knows no loyalty. If it makes sense, it makes dollars. If it makes dollars, it makes sense. Understand this right now. Why I say this is the greatest shift in our lifetime in the next 24 months. Everything will be settled for the future now. And once it's in place, there's no stopping this. But understand this. The mystique around the dollar is here to crush other assets. No cycles in finance are ever the same. Quantitative easing after 2008 changed the world forever. Zero interest rate policy, what Japan did, changed the world forever. Money printing, the zombie nation, changed the world forever. A lot of people talk about the carry trade. I used the carry trade to buy my first house. You don't undo the last 50 years of finance in 5 days. No different than when you put the frog in the pot of water and you start boiling it. It doesn't know that it's being killed. Unfortunately. Sad. It's just the water starts to just boil. Pay attention to what's quiet. Wither or more because we feast on everything. So that's why we're going up this frosty, frosty mountain, this long, frosty march with our frosty beverage, because the view from the top is going to be spectacular. Ladies and gentlemen, there's a lot of opportunity out here right now in the markets. We've seen swings that are unbelievable. Unbelievable. If you want your hand held, you want to be mentored, you want to learn to trade, you want to learn to invest, come and join us Crypto Public Desk Monthly. Over 600 active people, traders, investors, and they're taking advantage of everything. Learning life-changing knowledge. I'll see you there. I'll see you on the front lines. I love you all. Don't get caught up like sushi. This information is for education, entertainment purposes only. This is not financial advice, just my own opinion. Today was my own opinion, okay? Never invest based on watching a YouTube video. Don't ever do that. But here's the candy ice, the fortune cookie for you. If you've been watching our channel for a long time and you haven't joined the Patreon, you should, okay? You've been here. We're not crypto influencers. If you found the Crypto Republic, we're financial mercenaries. We're here to take advantage of what's happening. Long after the whole narrative, whatever clarity it gets passed, blah, 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 this, blah, 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 that, there'll be opportunity to be had in commodities, in equities. This is one of the oldest businesses of humanity, finance. The only question is, are you going to get off the sidelines and get in the game? Are you able to get in the game? What I learned on the floor of the New York Mercantile Exchange was passed down from father to son, mother to daughter. It was tradecraft. Very much like people learn to fish, learn to hunt. I was very lucky for my family from the New York Mercantile Exchange. Everyone wanted to be my friend. Don't get caught up like sushi. Don't FOMO this. Stay frosty. Get that Gucci conviction, that Gucci clarity. Have a blessed day. I'll see you in the front lines. I love you all.